In the archives of financial deceit, few tales can match the audacity, scale, and impact of the Ponzi scheme orchestrated by Bernie Madoff. A single man deceived the world's elite, charities, celebrities, and even ordinary hardworking people, amassing an unthinkable fortune by shrouding himself in a veil of trust and respectability. It's a tale of greed and deception, a cautionary tale that exposed glaring vulnerabilities in the world's financial system. This is the story of Bernie Madoff, the man behind an illusion so grand it was destined for an equally grand fall. Before we dive deeper into Madoff's world, it's important to understand exactly what a Ponzi scheme is. Named after Charles Ponzi, who became notorious for using the technique in the 1920s, a Ponzi scheme is a form of investment fraud. It works on a simple but deceptive premise. Early investors are promised high returns with little risk. The catch? These returns aren't funded through legitimate business activities or investments. Instead, the money contributed by new, often unsuspecting investors is used to pay the promised returns to earlier investors. This creates an illusion of profitability and legitimacy, attracting more investors and enabling the scheme to grow. But here's the problem. The scheme's survival relies on an ever-increasing flow of money from new investors. Like a house of cards, if the flow slows or stops, the whole structure collapses, leaving the latest investors with nothing. Ponzi schemes are inherently unsustainable and ultimately doomed to fail, yet they continue to ensnare victims because of their promise of easy wealth. Bernie Madoff, a name synonymous with financial deceit, was not always a figure of scandal. Born in 1938 in Queens, New York, Madoff was the son of European immigrants and came from a humble background. As a young man, he used money earned from working as a lifeguard and installing sprinklers to start his own investment firm, Bernard L. Madoff Investment Securities, in 1960. Madoff's firm quickly gained a reputation for its reliable profits and exclusive client list. His seeming ability to navigate the financial markets' ups and downs with consistent returns drew the attention of investors worldwide. But Madoff wasn't just an investor. His firm became one of the largest market makers, firms that stand ready to buy and sell securities for their own account on Wall Street. He was even a former chairman of the Nasdaq Stock Exchange, enhancing his image as a respected and integral part of the financial community. In the eyes of the world, Bernie Madoff was a financial mastermind. His firm was a bastion of stability in the volatile world of investing. Yet beneath this facade of success and reliability, the seeds of the largest Ponzi scheme in history were being sown. While it's difficult to pinpoint exactly when Madoff's operation crossed the line into outright fraud, investigators believe the scheme began in the late 1980s or early 1990s. Some suggest it could have started even earlier. Facing challenges in delivering the steady returns he was famous for, Madoff resorted to using funds from new investors to pay off older ones. This rotation, a classic hallmark of a Ponzi scheme, created a facade of profitability and reliability. And with Madoff's reputation as a financial wizard, few questioned the source of these consistent returns. With his sterling reputation and the promise of steady high returns, attracting new investors was not difficult for Madoff. Wealthy individuals, charitable foundations, universities, and even celebrities flocked to him, eager to partake in his supposed financial prowess. Maintaining this illusion, however, required a constant influx of new money. As the scheme grew, the amount needed to sustain it escalated, reaching into the billions. To help keep the illusion alive, Madoff and his team sent out detailed statements to investors, showing trades that had never occurred and gains that were purely fictional. These documents were a critical part of the scheme, reinforcing the belief that Madoff's strategy was working. At its peak, Madoff's fraudulent empire was reported to have a supposed value of $65 billion. But this wasn't real wealth, it was an illusion built on a mountain of lies. Madoff's scheme was a masterclass in deception, with red flags often dismissed due to his reputation and the seemingly infallible performance of his investments. However, there were warnings and missed opportunities that, had they been heeded, could have revealed the scam much earlier. Several financial analysts, including Harry Markopolos, raised concerns about Madoff's operations. Markopolos, a portfolio manager, started questioning Madoff's remarkably consistent returns as early as 1999. The high, consistent returns that Madoff offered, regardless of the market conditions, were simply too good to be true. Markopolos and his team flagged their concerns to the Securities and Exchange Commission, or the SEC, multiple times. However, these warnings fell on deaf ears. These missed opportunities underscored the need for better oversight in the financial industry. Unfortunately, the true nature of Madoff's scheme would only be uncovered once it was too late for many investors. Like all Ponzi schemes, Madoff's operation was a ticking time bomb. It relied on a continual influx of fresh capital. However, when the 2008 financial crisis hit, Madoff's well-crafted illusion began to unravel. As the market plunged, investors began to seek the safety of cash. Many tried to withdraw their investments from Madoff's firm. But with new money drying up and old money leaving, Madoff found himself unable to maintain the facade. By December 2008, the game was up. Bernie Madoff confessed his criminal activities to his sons, who then reported him to authorities. Madoff was arrested on December 11, 2008. The fallout from Madoff's scheme was both extensive and devastating. His arrest sent shockwaves throughout the global financial community, and the personal toll on his victims was catastrophic. Thousands of investors found their savings wiped out. Prominent charities and foundations faced insolvency as their investments with Madoff disappeared. The domino effect was felt far and wide. The scandal also shook faith in financial institutions and the regulatory bodies that were supposed to protect investors. The Securities and Exchange Commission faced intense criticism for its failure to detect the scheme despite receiving multiple warnings over the years. The Madoff case forced a re-examination of regulatory oversight in the financial industry and led to efforts to strengthen protections for investors. Madoff himself was sentenced to 150 years in prison in 2009, a symbolic lifetime for the man who masterminded the biggest financial fraud in history. He died on April 14, 2021 due to kidney disease. Thank you for joining us on this deep dive into the largest Ponzi scheme in modern history. If you found this video informative, please like, share, and subscribe for more insightful content.